Today we're going to talk about Dow theory. And just as a little background, you guys know that I taught physics for the last 28 years or so. So theory is very important. And just a simple definition of theory is nothing more than an explanation or a description of some phenomena, okay? So we're going to use it to understand trends in the market. It is also going to form the basis of technical analysis, chart reading. Okay, so we've been doing a lot of that lately. So many of the strategies that you're going to see that the so-called professionals would use are going to incorporate Dow theory. So one of the things that we want to do is to make sure that we're able to identify a trend in not only the market. Now, when I say market, I'm talking about the Standards and Poor's, the NASDAQ, could be the Russell 2000, the Russell 3000. So when we go out that level, we're really talking about a large accumulation of publicly traded companies, okay? So we're looking at those shares as a whole. And then from there, we want to break those markets down into sectors. There are about 11 sectors. And then from there, we want to break those sectors down into industries, okay? So this Dow theory, you got to imagine this was probably 100 or so years ago. And so at that time, they probably only had the Dow Jones Industrial Average. And then, of course, they had some other subsectors inside of that, such as the Dow Jones Transportation Average. Today, the Dow makes up about 30 of your largest publicly traded companies, okay? So even though we only had the Dow Jones during Charles Dow's day, today we have more indices than that. So these could apply to those indices as well. I want to say that straight off the bat. And then also we can use them to apply to individual stocks or companies, okay? All right, so the name Dow theory comes from a series of editorial pieces, like I said before, written by this guy named Charles Dow. Another guy that I didn't see mentioned there was Edward Jones as well. And both of them also started what we know today as the Wall Street Journal, okay? He never used this phrase himself. Rather, his works were collected and made sense of by people that followed him, such as Robert Rhea. Wyckoff would be another one that I'm going to mention here shortly. And like I've said before, the Dow theory is basically just technical analysis, trend-based. It is trend-based, and we're going to use charts in order to see those trends. And then Dow separated markets into different types of trends. We're going to talk about the three trends. We're going to talk about the phases of those trends. And then we're going to use that going down the road to allow us to enter and exit trades at the right time, okay? And we have to remember that's the whole point. Most of us have different goals when we do our trading. For example, my goal is to acquire wealth that I can utilize myself, and then, of course, that I could pass on to my heirs. Okay, so we want to make sure that we are, depending on what our trading strategies are, we may want the market to be in an uptrend. We may want the market to be in a downtrend. If we know what we're doing, we can take advantage of an upward trend and a downward trending market, just depending on the types of trading strategies that we use. So if we really understand this, it doesn't make a difference what the market is doing. We can take advantage of it in order to meet our trading goals. So that's important. And here are the 6 tenets or principles of Dow theory: that the market moves in trends, And again, like I said, that was attributed to Charles Dow. And then we have 3 trend phases, and that's attributed to Richard Wyckoff. There's a Wyckoff method for trading, and that the indices, the major indices, discounts all information. We're going to talk about these in a little bit more detail. Here, this basically just serves as an agenda, and the indices must confirm each other in order to be confident that a trend exists in a particular direction. And then we want to use volume. These are all of the players, both institutional, your hedge fund guys, your big fund managers, and then the retail traders like us. We are going to buy and sell these particular share or indices in the form of exchange traded funds, ETFs. And the trends continue until a reversal is confirmed. So these are the 6 tenets or principles of Dow theory. And like I said, we're going to get into each one of them in a little bit more detail. And so here are the types of market trends. You have a primary trend, you have a secondary trend, and you have what are called minor trends. I'm going to show you charts of these too, so don't be dismayed by what you're reading here. We're going to have an upward trend, which we're going to refer to as a bull market. There's also a downward trend, which we refer to as a bear market. And again, when you think of a bull market, just think about a bull that has horns on it, and it wants to attack. Those horns go upward. And a bear market, I want you to think about the paws of a bear. When it attacks, it'll take those paws and it will strike downward, okay? So that's one of the ways that we can think about why they utilize the phrases bull market and bear market. And these primary trends are generally going to last a year or more, okay? And within those primary trends, we're going to have what are called secondary trends, and these are medium-term corrections within the primary trend. For example, and the terminology is going to be different here. Some people would just use corrections, a pullback within a bull market, or a rally which moves in the original direction of the primary trend. Let's say if we had an upward facing trend, and whatever goes up comes down, right? At least for some period of time. We would refer to that as a correction. You could refer to it as a pullback. And then when the market starts back in its original primary direction, we could call that a rally in that particular direction. These secondary trends last anywhere from 3 weeks to about 3 months. And then within those primary trends and secondary trends, we're also going to have minor trends, and these are short-term fluctuations. You might also hear the term noise. And these are movements are upward or downward, and they last less than about 3 weeks, okay? These are general guidelines. I want you to think in terms of minor trends. You can also think in terms of, say, some news comes out. Let's say one of the Federal Reserve chairman comes out, the Open Market Committee, they give some news. You can have labor reports. So anything in the news may make a stock or an indices move in one particular direction. The tariffs are a good example of, at least for now, minor trends. Whenever there's news about these trends that the Trump administration is promising, you can see upward and downward moves. Now, for the most part, these moves have been downward, okay? We're only about, I think, no more than a month into his term. So we could call these maybe secondary trends. We'd have to look at the charts in order to make those confirmations. And then, of course, we'd have to look across indices to see confirmations. I can give you an example. Well, in time, we'll get to the confirmation. Again, I want to talk about the types. These are trends. There are two. One is called the bull market. Others called the bear market. Bull market, long-term trend is upward. Investor sentiment is optimistic. Okay. Just keep this in mind. When we are looking at charts, we are basically looking at human sentiment or investor sentiment. This is what they feel. They either feel optimistic or they can feel pessimistic. And if it's a bull market, we anticipate future economic growth, okay? Bear markets also the long-term trend is downward. Investor sentiment is pessimistic and anticipates a declining economic growth. And you guys can stop me at any time if you have any questions or anything that may be confusing. Here's an example of a primary trend over many years. This is the Standards and Poor's. This is the SPX, one of the ETFs that we use that tracks the Standards and Poor's 500. This is considered one of the major indices, by the way. This is the primary one that you're going to hear people talk about. And clearly we can see with our eyeballs, and that's one of the reasons that we utilize or that we like charts, is that we can see with our eyes what the trend is, okay? And so the Dow Jones Industrial Average, as like most averages over long periods of time, they always trend upward, except in those rare cases that we will have a bear market, okay? You can think of a depression of the Depression of 1929. That would be an example of a bear market. Okay, here I just want to note some other things in terms of technical analysis. The averages too. Now, you see two colored lines here. One is red, one is green. The red line is the 50-day moving average. And what that is the previous 50 days prices, and we take the average of those. The green line here is the 200-day moving average. So no matter what day it is, we'll have one of these lines or dots really is going to represent the moving average of the previous day's prices, either for the last 50 days or for the last 200 days. Okay, so the more recent is the 50-day, and then of course the one that has larger readings is going to be the 200 days. So it'll be the longer period. The 50-day is the shorter period. One of the ways that people look at this, they'll say, hey, if you can see my cursor here, you can see that the 50-day went below the 200-day. Okay, so here we had a bull market, but then it looks like this is in 2009. We were at a market. On 2009, thereabout, we were in a bear market. You can see that the trend is downward. Then it bottomed out, and then it came back up. Okay, and it continued its original trend, which is upward. So for you guys, it is typically the case that we want to be buyers of an index or a company, a publicly traded company. We want to make sure that the 50-day moving average always stays above the 200-day and that both are sloped upward. Okay, that would be a time to buy or to participate in the market, in a sector, in an industry, or in a particular stock or share. Okay, let me slow down. Does anyone have any questions about that? So here, since we're looking at long terms, we can see both a bear market, like I say, somewhere around 2009. And then after that, generally we had, and excuse me, I said that backwards. Here in about 2009, we had a bear market. And then after that, primarily we had a bull market. Then, of course, we have some secondary trends within a primary market. Here we can see that over the longer period of time, we're looking at a primary trend, which represents a bull market. But then for some months here, from about September to about March, we had a secondary market which trended downward. Okay? We had a secondary market which trended downward, and that would be considered just a secondary market. It didn't last any longer than, it only lasted, what is that, about 6 months or so. So 3 months into the previous fiscal or calendar year, and then 3 months into the most recent time period. This looks like from about 2015, September 2015, to around November or so. Then there was a rally, as you can see, somewhere in between October and November. And then you had a pullback again, starting in November all the way to the end of December. Then you had a correction in 2017, and then the market trended upward again all the way out 2017. Again, stop me if you have any questions. Here's another example of the SPX, which represents the Standards & Poor's 500. It's an ETF. Here we can see a primary trend primary trend. But then that we had some minor trends. In this case, we had a correction downward between June and July. So shorter time period, minor trend, say for an example, and I'm just making this up, maybe some tariff threats would be an example. But then the market corrected and continued in its original direction. Phases. Okay, so we talked about types of trends. We identified 3: primary, secondary, and minor. And within those trends, there's a bull market. There's a bear market. Within the bull market, that's the upward trending. That's the one that we like to see. You have what's called an accumulation phase, and during that, informed investors. Now, when I say informed investors, I'm talking about the big money managers, the hedge funds, the institutional investors. These are the guys that have all of the research, all of the analysts. They're going to have far more information than you and I, the retail investor, could ever have. And at this point, these guys are buying assets against the prevailing market sentiment. Okay, we're going to show you what that looks like on a chart, anticipating a trend reversal. So when everybody else is selling or has panicked, these guys are going to come in and buy. Okay? And then there's a public participation phase. That's where you and I come in, the retail investors. We see and recognize the trend, and then we want to get in on it, and we're going to drive the prices up. Let me slow down just a little bit. This is very important. Buyers, you don't remember anything that I say today. Remember that buyers drive the prices up. Sellers drive the prices down. Okay? And then, of course, there's supply and demand in there out there too. There are only so many shares available for a particular company. If you have more demand, i.e. more people wanting to buy into a particular share or index, they're going to drive the price up. Okay? And then, of course, when people are, there's some bad news, or the institutional folks, they begin to sell, and the public finds out, hey, they're dumping shares, then they're going to sell too. Okay? The bull market in the last phase after the public is the excess phase. Market activity becomes rampant, often leading to overvaluation before the trend reverses. Okay? This also, now, and I'll show you on the chart, this excess phase really can be considered distribution as well. It's going to be an example of where the institutional guys, they're selling ahead of the broader market. Okay, in other words, they've gotten their profits and now they're selling. And I'll show you on a chart, it's going to be choppy at the top of, say, of a bull market. It'll occur at the top. It'll trade within some range, and then it'll start to sell off. And we'll see that. Bear market, you have the distribution phase. Again, informed investors start to sell off their holdings, anticipating a downturn. The public gets wind of it. They participate in it. What do you have? You have more people selling, and they're driving the prices down. Okay? Then the panic phase, hey, everybody's selling, often leading to undervaluation before stabilization. So what we want to do is to follow the smart money. In other words, we want to buy when the institutional investors are buying, and we want to sell when they are selling. So with our charts and our candlesticks, we will be able to tell when they are buying and when they are selling. Okay? We want to do what the smart money does. And then, of course, recognizing these phases aids investors in timing their market entries and exits effectively. That's the whole purpose. And Dow Theory sets the basis for our strategies. Okay, the accumulation. This chart here is going to show an accumulation, is going to show the accumulation and the distribution phases. Here you can see between 2008 and 2009, we had distribution. It's a bear market, right? Look what's happened. People are selling more than they are buying. In 2009, you can see that the market bottoms out, or bottomed out, and there was a reversal. In other words, reversals, we had higher lows. I want you to think of each one of these as a day, and that let's say today, for example, the lows for the day are higher than they were the previous day. Okay? Let me say this, within each day, there's what we call a trading range. A trading range. You will have a high for that day. You will have a low for that day. And then you will trade in between the high price of a stock and the low price of a stock. And that would be considered your trading range. So you're going to know if a reversal has happened. In this case, we had a downward trending primary market, and then there was a reversal sometime in 2009. And we know that because what we should anticipate is over consecutive days, we're going to have higher lows and higher highs. Okay. Now, here's how we're going to know that the institutional investors are involved. And this is going to be my most important point. The trading ranges are going to be wider. Okay. I'm going to say that again. You're going to know that the institutional guys are involved because you're going to see trading ranges that are larger and larger. In other words, you're going to see large candlesticks. You're going to see large, let me be more specific, green candlesticks. Green represents buying, red represents selling, okay? When we talk about candlesticks, and for the new folks, we did have a previous video where we discussed candlesticks, the nomenclature, and then candlestick patterns. Those candlestick patterns will also help you determine when the institutional buyers are in play, whether they are buying and whether they are selling. Some candlestick patterns also are what we would call indecision. In other words, no one has control, okay? No one has control. In other words, the buyers and the sellers are about even. They are battling against each other, as opposed to a day where the buyers have control, they're driving the prices up, or as opposed to a day where the sellers have control and they are driving the prices down. So you're going to see the institutional players either way. If they are selling, you're going to see large candlesticks or long candlesticks where the closing price is below the opening price for the day, okay? Keep in mind that most markets open at 9:30 in the morning. So when they open, there's an open price, okay? For the buyers, when the buyers have control, we expect that the closing price, for most indices, the closing occurs at 4 p.m. And so at 4 p.m., we expect that price to be higher than the price at 9:30 in the morning. I hope that makes sense. And then we have the converse of that, where the sellers have control. That is the closing price, the price at 4 p.m. is below the price at 9:30 a.m. Okay? And you're going to know that the institutional players are involved just by the range of those prices during the day. We call that price action. You're going to hear that term a lot, and it's nothing more than the trading range within a particular period. Okay? Here we can see, again, the accumulation phase. In other words, we've come out of a downward trend, and we can see a little bit of confirmation. The market hasn't quite made it back to where it was. Here you can see it had a high way back in 2008. Hasn't made it back, so it's still clawing its way back. But then here we can see we're trading in a range. We're going to later, but I would here see that the market is much moving sideways within a narrow range. We call that a line. Okay? And this is where accumulation, that means that the institutional guys are acquiring shares. Okay? So we had two here. We had distribution. Here we have, and actually here we have what we call a markup. We're going to see that later. And this is accumulation, more markup. And then later, we're going to see some distribution. Let me slow down. Does anyone have any questions about this particular chart? Okay, just think accumulation. That's when the institutional or the smart money guys are acquiring shares without making a lot of noise. The market hasn't, the broader market hasn't really caught on yet. Okay. Then when we start to drive that price up, that's when the public or the broader market comes in, the retail guys, they're going to drive that price up. Now, that doesn't mean there isn't going to be any corrections, but here all you need to know is that in an upward trend, you're getting higher highs, okay? Here's a high here, then here's a higher high, then here's another higher high, and then another higher high. Okay, that's when you know that you're in an upward trending market. On the distribution side, you're going to have lower highs and lower lows. Okay, I'm talking about the high price for the day and the low price for the day are some of the ways that we help to identify whether we're in a downward trending market and an upward trending market. Okay, here's an example of the public participation page, public participation phase. That's when you and I normally come in. But if you guys stay in the group, we're going to learn how to trade like the smart money. Okay, and actually following this particular forum, the next couple of forums, I'm going to show you what the how to follow the smart money. Okay, and I've already given you an indication by my mention of candlesticks. We're going to look for large candlesticks, either the green ones or the red ones, it doesn't matter. And that's going to help us to identify what phase or when we should enter into a particular trade. Okay, here's an example here. We're basically using the same chart, high of the last market cycle. That was previous, say, 2005 to 2008. So we reached a high somewhere in, looks like 2008. And then we had a bear market from about maybe the end of 2008 to 2009. And then the market, we're back to a bull market with some secondary trends. But here's an example of the, we're back to where we started. In other words, the market's back to where it was in 2008 and 2013. And then look what happened. So you're going to know that somewhere along this line was accumulation, right? And then this phase, we call it public participation, but it's also going to be referred to as a markup. In other words, there's a lot of demand since now the retail investor has joined the institutional investor. There's more demand, which is going to drive the price up. Again, there's only so many shares to be had. Everybody's competing for the same amount or the same amount of shares, right? Or should I say, there's only a limited amount of shares, but the demand is greater than the supply. We're going to drive the price up. That's the better way to say that. Okay? So that's the markup. Over here is what we would consider a mark down. Okay? During the distribution phase, there's a mark down. Here again, an access phase, that's in a bull market, right? What do you think's happening in the access phase? Somebody, let's see who's been paying attention. What do you guys, let me be more specific. What do you guys think that the smart money is doing in the access phase?
Does that mean there's a lot of buying?
Not in the access phase. Not for not for the smart money. I'm talking about the smart money.
Oh, okay.
The smart money is selling. This is also where we're at the top, right?
Yes.
See how choppy it is at the top?
Yep.
This is where the smart money is going to start offloading the shares that they have. And this is one of the reasons that many people, the retail investor, becomes disenchanted with investing in the stock market is because they get in at the wrong phase. In other words, they get in at the top. But look what happens when you go to the top.
Yeah.
Look at that. What happens? That's just, we don't have to look at this as the S&P as a whole. This could be, say, Tesla.
Yeah.
Yeah, this is Tesla. So I've done it before. I've gotten in at the top. I heard somebody mention something or I saw something on the news and I said, hey, I want in. And then it drops off and I'm like, man, what happened? I got in at the wrong point. Okay. So this would be considered access. On the other side of that, like I said, up here, the market or the stock is considered overvalued. In other
Okay. That
words,
makes sense.
the earnings do not justify the price. Man, that company isn't even making any money and people are driving up the price on it. Okay. Now, generally, charts are not based on fundamentals. This is technically what they're saying. We're neglecting the fundamentals. I don't actually think so, but I think for the most part that the general public may not be aware of the fundamentals and they just want to get in on momentum. Okay. They're not paying attention to the fundamentals, i.e., what are the revenues and the profits of the company. They're just want to get in on momentum. They're called momentum traders. Okay. Again, that goes back to those long candlesticks. That's where the price is being driven up. You have higher highs. The trading range is large compared to what it is normally. And people want to get in on that. You can make money on that, but you need to get in at the right time before the momentum wears off. In other words, up here at the top, momentum wears off, stocks are overpriced, then the selling. Okay. That's what we're referring to as the panic phase. It is also distribution. Okay. It is distribution. When you think distribution, just think selling. That's a better way to look at it. Access phase, markup. In other words, everybody really wants to get involved. There's upward momentum, upward pressure, but secretly, the institutional buyers are selling at the top. Okay. And normally it'll be choppy at the top. This one, again, we're looking at it over a number of years. If we were just looking at it over a year instead of a number of years, we would see a choppy top. It'll be trading within a range, going up, going down, and really what we'd expect to see. Here you can sort of see it with these larger candlesticks, the white ones. The white ones are buying, excuse me, the blue ones or aqua, whatever color that is. Consider that as buying. The buyers have control, and the white ones, the sellers have control. Okay. Look at those large trading ranges. The institutional buyers, they are selling those shares. Yeah, a good example. Yeah, Everett, you see here, a good example is gold. You're right. Okay, we could use this for any type of security, commodity, or what have you. If we can chart it, they're going to have the same type of trends and phases, okay? Okay, here's another one of the tenets. The market discounts everything. Okay, said another way, the market knows all. Now, in Dow's time, he claimed that excessive manipulation of the market was not possible. I want you to imagine these are some real huge companies, right? And so it's going to be almost impossible for one person to manipulate a market that is very large, okay? Manipulation of individual stocks and small movement and indices are possible, but could not continue indefinitely, okay? At some point, manipulation is discounted. In one of the forums, we talked about net present value and the discount. Trying to think of what the name of it was. There's a discounting method in which at least the analysts, these are the smart money, right? They will determine whether or not they want to invest in a particular company or in a particular industry. What they'll do is they'll look at future revenues or future earnings. What are going to be the profits, the anticipated profits over a number of years? And they will discount those future profits to the present. Okay, so this helps them to determine whether to invest in a company or not to invest in a company. Okay, keep in mind they're going to put up X number of dollars. And for those X number of dollars, they want to get above and beyond what they invest, right? So we want those future earnings to be greater, of course, than what we are going to invest, okay? And they can do these sophisticated calculations. And if those future earnings are not greater than the amount that they are going to invest, they will not invest in that company or industry. Okay? So when you hear that term discounted, this is what we are referring to. We are discounting the present value, which should be less than the future earnings of a particular company. The primary trend could not be manipulated as the market is too large. And of course, we have some intuition for that. It is very hard to move something that has a lot of mass to it, just to use some physics terminology. However, applying this principle in modern post-internet marketplace, there are many more manipulation opportunities, especially in the small cap world. Now, for those of us that follow, we had many examples of this. I never participated in it. One of the stocks that I'm thinking about, Andrew, help me out. During the pandemic, what was that one stock that these chat room guys, TikTok, I think they were on TikTok, they kept driving the price. You can go to this particular store and you can trade in your video games or something to that effect. What was the name of that company? Anybody?
I can't recall it right off the back though.
Another one, it was another one that was a theater. Hold up, here's what I'm gonna do. I'm gonna stop this for a second. It was one of those some other ones were some of those meme stocks. They call them meme stocks.
Oh, that was AMC and
Yeah, AMC
uh
was one, which is
and
the
that game
GameStop. GameStop.
There we go.
GameStop. There you go. Thank you. Yeah, now if you know GameStop, they weren't making any money. But you had some of the retail investors, they teamed up and said, hey, we're going to buy when the institutional guys are selling. Okay. And this is achievable. This is really only going to be achievable when you're looking at a small company, and there's really not that many shares out there. Okay. So there's not a lot of supply. So in that particular case, and not quite, they had to be pretty, at least these followers, these TikTok followers, there had to be a pretty significant number of them in order to drive the price of GameStop up. And I know some people made a lot of money off of that. I'm talking about in the millions, multi-millions, by driving that price up and then, of course, selling it at the top. And it was done more than a few times, too. AMC, I guess at that time, no one was going to the theater. So I really don't quite understand. I really don't quite understand that one. They definitely weren't making any money, but they were driving the price up of AMC as well.
It was
And
that one
so,
guy, Marlon. It was some guy named Roaring Kitty. I remember him. He had a large follower. So what he would do is hype up the stock, and he would do like a manipulation and say he's buying X amount, and he would post how many shares he bought. People would rush in and buy it, and then he would hype it up again, and then a lot of more people come in, and then he would sell.
yeah. Well, we don't want to be caught in that. I never bought it because I knew about hype. Okay, that's all it was, is hype. There were no fundamentals, no underlying fundamentals. The company wasn't making any money, neither was AMC. And so it didn't make any sense to get into that unless you were willing to get in and get out quick. I never touched it. But generally the market discounts everything, okay? In other words, it knows everything, present and future. Everything is discounted into the market. Even Trump's tariffs are discounted into the market. So the theory goes, right? All right, another tenet of Dow theory is confirmation and volume. Okay. In other words, during Dow's time, we needed two indices. One was the Dow Jones Industrial Average, and within that, we had a Dow Jones Transportation Average. And to confirm the trend, each indices had to move in the same direction. Okay, I'll show you an example of that. And then volume should increase in the direction of the trend. Here, I want to say we're going to, generally when you look at a chart, it'll not have not only the price action on it, but it'll also have the volume on it. And so we want to use, I'll show you a picture of that. In other words, when there's a lot of buying pressure, we should be able to see that in the volume. In other words, we should see a larger volume, right? Same thing with selling pressure. We should see larger volume, okay? And generally, that's going to be the case when the institutional investors are involved. We'll look at some charts of that. Again, this is all part of one of the tenets of Dow theory. We have to have confirmation in the indices and in the volume. Let's see what that looks like. Okay, here's the Dow Jones Industrial Average and the Dow Jones Transportation Average. Look at the shapes. In other words, Their shapes mirror for the most part. Here's one example when they did not confirm each other. That looks like in November, but generally they're moving in the same direction. Here they're moving in the same direction. Here they're generally moving in the same direction. Here this one's upward. This one is also upward. This one is upward. This upward. We had some corrections, but generally speaking, they confirmed one another, and at few points they did not confirm, but overall the trend was upward. In this case, they won't be perfect, but they'll generally have the same shape. I like to say they'll have the same shape. Anybody have any questions on that? Oh, okay, so today, and which is going to be more important to us, many of us, I'll take that back. Some of us, especially the institutional guys, are investing more in the Dow Jones Industrial Average than they are in, say, the NASDAQ. NASDAQ, you have a lot of technology companies. And the Dow, you have some too. Apple's part of that. But these companies in the Dow are the largest companies. Okay? So in terms of inflation and in terms of assets, in terms of market valuation, they have so much money that they can withstand market downturns. Whereas a smaller company, they may go bankrupt. Okay, so people tend to deal with the larger companies when when there is market uncertainty, such as what we have right now, mainly because of inflation worries, but here lately more because of these tariff threats. Okay, they're coming very erratically. There was no real plan. At least to me, hey, let's try something and see what happened, and we'll make adjustments afterward. There was no detailed plan on how these tariffs were going to be rolled out. They're all happenstance. And they change. He'll say he's going to put a tariff on, and then he'll come back. He'll change his mind, and he say, okay, I'm going to hold off. And that creates all types of uncertainty, okay? But for us, we're going to look at in later forums, we're going to start with the market, okay? For us, it'll primarily probably be the Standard & Poor's 500. And then within that, we'll look at sectors. We'll look at, does the sector confirm the major index? And then within that sector, we'll go to industries, and we'll ask, does the industry index confirm the major index? Okay, and that's one of the ways that we'll tell if a trend exists. Now, once we get into, and then aside from that, what we want to do is to look at each one of those. The ultimate goal is to find the industry that's in an uptrend and that has a wide range in price action. In other words, we want to find the best performing sectors, then the best performing industries within that sector, and then we want to find the best performing stocks within that industry. And for us, that's going to be determined not only by the performance, but also by, for people like me, for the short-term guys, the swing traders and the day traders, I'm going to be looking for what's called average true range. In other words, I want to look for the widest margins of price action. I generally don't want to go any lower than $1.50. I want the difference between the high price and the low price to be at least $1.50. If I can get high, the higher, the better. Those are the stocks that I'm going to look at, and I have some strategies that I will use to determine if the smart money is buying. And for me, those are going to be those large candlesticks. I want to see confirmation. I want to see at least two candlesticks. I want to start at different time periods. I want to look at the month. I want to see a green candlestick for the month. I'm going to look at the week. I want to see a green candlestick, and I want it to be well bid. In other words, I want to see range. When I look at the week, then I'm going to look at the day. I want to see green. Okay, and then what I'm going to do is I'm going to go intraday. I'm going to go hour 15. I'm probably not going to go any lower than maybe 5. I may start at 5 and then look for confirmation at the 15. Within those 5-minute intervals, I want to see range, right? I want to see average true range. I want to see large candlesticks. I do not want, or I will not take action on small candlesticks. If I see 2 large candlesticks, I can guarantee you I'm going in. I'm going to set my entry price. My stop loss is going to be the low on the previous candlestick. We'll talk about this going forward. I'm really trying to get at the importance of understanding Dow theory. Okay? The strategy that I just relayed to you really comes from Dow theory. Okay? You heard me mention the term, I need to confirm the sector with the major index. And then I need to confirm that the industry is moving in the same direction as the sector and in the same direction as the major index. Let me slow down. Does anyone have any questions on that?
I don't know if maybe I do have a question. I'm trying to wrap this around my head, and maybe I'm thinking too far ahead and I need to do 2 or 3 more of your training sessions. But if I'm paying attention to the utilities and the health companies like Eli Lilly, should I be looking also at the other? Well, I should say Duke. Should I pay attention to other companies like Duke and other companies like Eli Lilly to get a good sense of the trend, or just stay focused on what those two are doing?
You are partly correct. But listen to what I said. You want to start with the major index first. In other words, you want to see what the Standards and Poor's is doing.
Okay.
Now, I'm not quite understanding how this works, but it generally works like this. For the most part, I didn't mean to do that. For the most part, the stocks follow the industry and the sector. And I think it mainly has to do with how they're weighted. The ones that are with the larger market caps. I'll give you an example. NVIDIA has a large market cap. Okay? When it does poorly, the NASDAQ does poorly. Does that make sense?
Yeah, I hear a lot of people talk about NVIDIA.
As an example, is on Dow. I don't think it's the largest. I think your Eli Lilly is in the Dow. I think I saw that in the Dow.
Yeah.
And those may be more heavily weighted than, say, an Apple would be. I don't think NVIDIA is in the Dow. I'd have to look. I know Microsoft is up there. But Microsoft, you know, that has a large market valuation, but it's not the largest in the Dow. I can tell you that. Okay? So the ones with the larger market cap are going to be more weighted. Those are the ones that are going to drive the index up or down. The ones with the larger market caps. So generally they follow each other. If you understand Dow theory, they're generally going to move in the same direction. So before I would even look at Eli Lilly or Duke or any of those companies, I would start at the market. I would work my way down to the sector, and then I would work my way down to the industry. Okay, at the minimum, I would look at what the industry is doing. Because generally, if the industry is doing well, then most, if not all, of the companies within that industry are doing well. Okay, because what you don't want to have is a case where the stock, the ones that are going to perform the best are the ones that are going to move in the direction of their industry and their sector. Does that make sense? That
Yes,
is
it does.
generally the case. Now, are you going to have some companies that are going to go against the industry? Sometimes you will, but for the most part, they're going to move in the direction of that industry.
Hey, hey, Marlon.
Yeah.
I think, well, I don't think, but the ones that usually kind of is heavily watched is Apple. I want to say it's Nvidia, Microsoft, Amazon, Google, and I want to say Meta. And I know Berkshire Hathaway, the B one, the BRK.B, are one of the ones that are heavily weighted. So what I typically do is look and see how those are moving, and those will kind of fluctuate. I think they call it like the Magnificent Seven, I believe.
Yes, that's for the NASDAQ.
Okay.
But when you get into the Dow, though, these are, with the exception of Apple and Microsoft, I don't hold up. I
Mhm.
think I have let me slow down here.
Those are the main ones that I watch, though.
Like I know Apple was going against, it's a technology company, but it was going against the grain. While the Nvidias were going down and all of the other techs were going down, Apple was going up. But guess what happened? Apple had a correction. As a matter of fact, let me pull up, I'm going to pull up Apple.
Yeah, they had a huge correction.
That's what I'm trying to tell you. They may run against the trend for a while, but I'm going to do year to date. Okay, let me share this, and then you guys will see the different trends for Apple. Okay, this is Apple year to date. This is from January 1st until now. Latanya, what's the trend? Upward or downward?
It's downward.
Yeah. Now, hey, you did have some minor trends where it's going against the grain, but then starting at about, it looks like February 25th, it had a high. And then from that point, it's trending down. It had some minor corrections there, but hey, this could be a reversal. I don't think so. Who can tell me why I don't think so? Everett, why do I not think that this is going to trend back upward? Now, I could be wrong on this, but if you're paying attention to what I have talked about today, who can tell me why I don't think Apple is going to have a reversal and trend upward?
I would say the tariffs that are taking place, and has Apple come out with anything newer?
That's a catalyst. That's a catalyst. The tariffs are a catalyst that would affect the direction of the trend. Now, here's why. I'm using confirmation. I'm using Dow theory to suggest that, hey, Apple, Because you know, Apple, all of the analysts said that this was a bad year for Apple in terms of sales. One of the reasons why, because you know, Apple is in China, right?
Right.
And the Chinese, they're sort of, man, we don't, you Americans, man, y'all tripping. So they're not buying Apple. Like they're buying, what's the name of the phone company? Is it Huawei? Some kind of strange name, starts with an H. It's a large Chinese telecommunications company. They make cell phones as well. I can't think of the name of them. Starts with an H. It was a big deal with the federal government in terms of espionage, and they put sanctions on this Chinese company. I think I can spell it. Let me see. Stock price. I think it's HUAWI or something. Can you guys see that? I can't pronounce that. I don't know. I don't even know how to
Huawei.
pronounce it. Huawei.
Yep.
Let's see what their chart looks like. Let's see. Market Watch. They normally have that chart. I want to use that. Let's see. I'm looking for a chart. Stop. Where's the chart?
No, you just, oh, I mean, hold on. Sorry about
Yeah.
that.
Okay, they don't want to show me a chart for that one. It probably doesn't trade. Okay, well, that's the company. Let's look at some indices, and I'm going to show you why. I do a lot of charting. I have a whole lot of charts. And let's go stock price SPX. Let's use that one. Let's start with that one. Okay, this is Standard & Poor's 500. Let's do year to date. This is just for a day, which trended upward, which is like a minor trend. But watch this. That's the S&P. Notice that it topped out. This February 19th is an important day. What I noticed is that on that date, all of the indices started into a downward trend. Let's do NASDAQ, QQQ. Year to date, bam, down 6%. Let's do, and I don't know the symbols. Let's do Russell 2000, which 2000 are the very small cap company. Year to date, you see where I'm going? I do not have a good prognosis for the market this year. Okay? So what I am doing is I am waiting for them to bottom out. The stocks that I'm looking at, I'm waiting for them to bottom out. And I'm using something called the Fibonacci retracements to let me know when they have bottomed out. Okay? I'm trying to buy them when they are near their 52-week low for 2024. Okay? And many of these corrections that you're going to see will be anywhere from 33 to 60 cent percent correction from that all-time high. What did I miss? Let's see what the Dow is doing. Uh-oh, I didn't mean to do that. All right, who wants to guess? What is the Dow year to date? Is it up or down?
It's down.
Down, let's see. Oh, yeah. Hey, that's all three major indices. These are the markets as a whole. This is what I want you to see, right? If you understand what we have been talking about today, this is how you can make use of it as a trader. If the market's going to trend down, you want to use a strategy. That's if you're a short-term trader like me. I'm going to be shorting stocks. In other words, I'm going to sell them. I'm going to sell stocks that I don't even own. I'm going to wait for the price to drop. And then I'm going to buy them to close them out. I'm never going to own them. And I'm going to make a profit that way. Okay? In an upward trending market, of course, I want to buy. I want to buy at the right time. I want to sell when the price goes up. And keep doing that over and over. But this year, at least to this point, the market is trending downward. I don't expect it to get any better because of the indecision in the White House. And these other nations that compete with us, European Union, Asian markets, they're not just going to sit back and let us dictate their the economics of their country. Okay, they're not going to allow their GDP to be affected in this zero-sum game, what I call this King George III mercantile trade policy. Okay, this is what Great Britain did to the American colonists. They imposed tariffs on them, on the goods that they were exporting. They wanted those raw materials to come to Great Britain so that they can manufacture them and then sell them to the wider market. Mercantile trade policies, what I refer to them as. All right, let's finish up the presentation. Hopefully you guys, if you have any questions, let me share this. Let me stop and reshare. Okay, so now you guys have an idea of what the markets are doing in 2025. Now, here's let me tell you this now. The markets, we were in a bull market. Many of the companies that I was tracking had their highs in 2025. And now they have corrected. Many of them have made large corrections downward. Okay? I ended up selling a lot of mine. And I'm waiting for an opportunity for them to bottom out. And I'll go back in. And I'm going to use what I'm showing you guys to follow what the institutional buyers are doing. This is something that I'm just becoming aware of. I study this stuff every day. I want you guys to know that, and to come up with other strategies, right? It'll help me to make money whether we have a down market, a downward trending market, or an upward trending market. All right, so indices must confirm the trend. In other words, we need at least two indices. It doesn't make a difference where you start. If you're in the Dow Jones, then they have sectors within the Dow Jones as well, and industries within the Dow. And the same thing with Ford. That was on the company. You're not going to have much there. Here's one with the volume. On any chart, the black line, that's the price action, up and down. The lines down here represent volume. Okay? Now, here's what volume must confirm trend. Here you can see we clearly have an upward trend. That means the buyers have control, but here's how we know for sure. Look at this large bar right here. The blue represents the buyers had control. If you set your volume chart up, you should set it up so that it's colored. I set mine up so that the green represents the buyers had control on that day, and the sellers I put in red. The sellers had control. If you see the volume. So here you can see, and look at the colors. Look at the blue lines. I'm talking about from this part right here where it says buying pressure. Yeah, it looks like you have more blue lines than you had red lines. And here you had, that was definitely institutional buyers came in here. Really this, if you were to take an average of this, it would probably be somewhere in the middle here. And so there are days where the volume is far above the average. That's what I'm talking about. Here's an example here where look where you have downward selling pressure, means the sellers had control. Look at that large bar for volume, and it's red. Okay. So during this period, we can see we had more red bars than we had blue bars. Other examples, buying pressure, markup phases. Anybody have any questions on that? So not only do you want to look at what the price action is, what the trend is, you also want to make sure that the volume confirms the trend, because it could be a minor trend and then it moves in the opposite direction or has a reversal. Okay. The volume is going to indicate conviction. In other words, I'm sure that this stock or this ETF is going to move upward or it's going to move downward. Okay, so we want to see above average trading volume during these periods. This is very important. Dr. Branham, these terms ought to make a lot of sense to you. When you think confirmation, you should be thinking validation, okay?
Sure.
You should be thinking, in other words, we want to validate a belief that we have in these PhD programs. That's one of the things they teach there is validation, which is nothing more than to make good. In other words, hey, we have some belief or some opinion, and we want some other means to help us validate or make good our belief or our opinion. Okay.
Sure.
You're gonna see me, and for those of you that have been staying with me, and Andrew, you in particular, you and Anthony, it looks like he left out though. You're gonna hear me say validation a whole lot. I mean, I can't trade without validation or confirmation. I'm not
The
gonna do
question
it.
is why do you trust it? Given the question is why do you trust it? Because it's all a risk, but you trust it enough to make your decision to buy or sell or what have you. What makes you trust it?
Well, number one, you have to have a strategy. Let me start from the beginning. First of all, you have to understand what your risk tolerance is. Are you conservative? Are you aggressive? Are you a momentum trader? Are you in, or are you into, well, let me take the momentum out. Are you conservative? Are you aggressive? Or are you in between?
Yes.
Okay, do you like, if you're aggressive, you like growth. I like to invest in companies that have a lot of growth, and I'm willing to put up my money to achieve my goal, which is wealth, right? Some people want income. They don't, some people are conservative. They don't want to, they're not very risky. And so they would probably deal in your large companies, like the companies that are in the Dow. They'd probably buy an Apple or something, or a Microsoft, as an example. Not going to be a lot of growth, but they're steady, right?
I agree.
Another example, I'm into quantum computing stocks. They're not making any money. And as far as what many of the people in the know have said, we don't even know what to do with computers that fast. They haven't even thought of what they can do with computers that move that fast. They can process information faster than humans ever could. What it would take a human or a group of humans thousands of years to do, these computers can do in a few seconds, these quantum computers. Okay? But I'm willing to put up the money because of the potential growth that I see with these companies. Now, having said that, I'll chart those as well. Some of them had their highs in 2025, and they haven't made a dime. Okay, they have negative earnings. They're burning through cash. All right, so to answer LaTanya, we haven't gotten into strategy. There's some strategies. Now, I mentioned some things. I want to have confirmation. I want to look at performance. In other words, I want to look within the market that is performing the best. And then I want to look within the sector that is performing the best within that market. And then I want to look at the industry that is performing best. And then within that industry, I want to choose the company that is performing best. Now, at that level, I have opinion too. You're going to look at some things and say, yeah, I utilize that product or service. And every time I go shopping, they're always busy. Costco may be an example. Okay, it is a defensive stock as well. So when you have inflation fears, people are still going to have to buy food and what have you. So it would be considered a defensive stock. And maybe we want to look there, look within defensive stocks and say, hey, who's performing the best? I know Costco is outperforming Walmart at this point. So there is some leeway there for you to put your own valuation measures in there. You may want to go look at the fundamentals. That's something different outside of the charting. Previously, we have talked about fundamentals. Fundamentals are important to me. If I'm going to be a long-term investor, fundamentals are very important. If I want to make money in the short term, maybe they're not that important, okay?
How did you classify Costco again?
Is a defensive stock.
Defensive. Okay.
Yes. In other words, you can expect them not to do poorly. I'm going to say this way. They're not going to do poorly like these technology stocks are doing. Okay? In other words, you shouldn't expect to see huge drops, and you may even see some capital appreciation with a company like Costco. As a matter of fact, let's see what time we got. I think I'm near the end here. Let me finish this up, and then we'll look at some of these particular companies, okay? Trends persist until a clear reversal occurs. Dow Theory posits that a trend remains in effect until there is definitive evidence of its reversal. This means that temporary market fluctuations or corrections, those are your minor trends, right, are not considered trend reversals unless confirmed by significant and sustained movements in the opposite direction. There's a number of strategies to do this. We can look at crossovers of the 50-day. Let's say the 50-day crossover goes below the 200-day. And let's say it stays there, right? All right, that's an example of a trend reversal. And the opposite would be the 50-day moves above the 200-day. That's also indication of a trend reversal. How long does it do that? Okay. We want to see in an upward trending market, we want to see the price action above the average because we want to know, or we should know, that an average is a lagging indicator. It's lagging, so it's going to have some delay when you compare it to the price action because you're looking at an average, okay? And again, the way I like to look at it, we want our test grades. This is an example. We want our test grades to be above the average. But at some points, we may get a low test grade, which would be below our average grade. Okay? So if we are above our average, we want to be buyers. If we are below our average, we may want to be sellers. So those lines that we saw, we want to see the candlesticks above the average, especially if we anticipate an upward trending market. If we see those candlesticks below the average, we know that we are in a downward trending market and we may want to sell or use some other strategy such as short selling. It just depends on your level of experience and the techniques that you have, that you are aware of and that you can make use of, okay? And again, we've already mentioned some of this. Let's go ahead, and I think we're at the end here. Here's an example of what a trading range is. Here we can clearly see an upward trend. And then the lines here, in other words, we have some lows here. This would be considered a support or a floor. And then up here, these lines intersect 3 tops that will be considered resistance. In other words, let's say if we're looking at a stock, and this is Apple, by the way, and from about July to about, well, for a full year, it traded in a range. Okay, in other words, if we're going to trade this, there's going to be a point where it's going to have to break out. And we can see that toward July, it broke out above the resistance level. Think of the resistance as a ceiling. And we are all familiar with the glass ceiling. We get to a point of position within a company, and above that position, we cannot go. That's called a glass ceiling. Here, this is how I want you to think of the resistance level. These charts allow us to see support levels. In other words, okay, it's not going to go below that level. That's why we call it support. That's the time to buy. So at the support level, we say that the position is oversold. In other words, down here, at this point, Apple was oversold. Normally when it's oversold, that's where the institutions are going to come in. The retail buyers are going to come in. They're going to become buyers. They're going to drive the price up. So notice, and I don't know what level that is, it looks like 168, maybe $164 at the lowest level. So in other words, Apple during this year period never went below $164. But it never went above, it looks like, $194 or so. And then at the end of, or maybe at the beginning of July, look what happened. Andrew, what do you think happened right here? Look at this steep. What happened right here?
They started selling.
At this point where my cursor is, right here, that's a breakout.
Oh, you talking about when the buyers came in?
Yeah, that's the buyers
Okay.
right there.
I thought you had the cursor on the other side. My apologies.
Yeah, that somebody coming in there. Those are large. Oh,
Institutions.
yeah, those are your institutions coming in there. Or maybe or maybe I'm going to say not your institutions, but I'm going to have I'm going to say your retail guy. Because really your institutions were buying here. This is the accumulation phase. Accumulation phase. You had a little bit of markup, then you had some corrections. Another markup, or not markup, but accumulation. That's when your institutional guys are coming in near the floor or the support. Markup, access. What is this right here at the top? What is this phase at the top? From about July to September. Let me ask that. I got to ask it the right way. What was the smart money doing? Choppy top, right?
I believe smart money was buying.
No,
More so consolidating.
that's consolidation. They were selling.
Okay.
Now, what do you think? They're not showing it on this chart, but I can guarantee you, here's a phase right here. Look, all doing here, this is when we came in. This is when the novice comes in, driving that price up. Remember, here's the institutional buyers right here. From about March to about July. Then here comes the retail guys in the access phase. The institutional guys, man, we selling, man. Look at this. Look what happens here. Drive it back up, sell a little bit more, drive back up. And you don't see it on that other side, but I'm pretty sure there's probably a little bit of selling that took place there as well. Some more examples: Dow Jones and Industrial Average versus the Dow Jones Transportation Index. This is during that COVID period, right? Look, prior to 2014 on up, we were in a bull market. Right here, 2020 or so, market collapsed. Everybody's selling. Well, here's where the confirmation comes in. Look here. This was the high. This was a higher high. This was the look. Here's the high point. Well, let's go down to the DJT. The high point was in 2018. And of course, I can't see that good, but let's say that was like 12,000. In 2020, at the same time that the Dow Jones Industrial Average was at its highest high up to that point, the DJT did not confirm it. In other words, I wish I could draw a line on that, but this point where you see my cursor or where the circle is not higher than this point to the left of it. So in other words, it did not confirm what happened up here. Here's a high, then here's a higher high. Here's a high, but here's a higher high, and then another higher high. Here you had a higher high, and then a lower high, and then this sort of traded in a range. It did not confirm what happened in the Dow Jones Industrial Average, and that's when the trend reversed and you had a collapse. Okay, eventually it regained its footing and had an upward trending market. That's when people were making a killing. I don't know about you guys. I was making quite a bit of money during that. When we were at home, we weren't working. I could sit behind my computer, I could teach my classes, and I can trade at the same time. Okay. That's pretty much going to conclude the presentation. Anyone have any questions? Again,
No
in the late,
questions, just thank you.
you are welcome. Everett, you got any questions?
I just want to say it's good. I learned, from just listening to you. I just learned some nomenclatures like the bull and the bear. I never knew bull mean up, bear mean, I never knew that.
Okay, okay.
Let's see, what else? The minor trends, S&P, you know how the buyers drive it up, sellers drive it down. I never knew that, you know.
Okay.
But right now I'm in the mutual fund. And are you familiar with TSP?
Is that TS?
That's thrift savings plan.
That's federal government,
Yeah,
military.
okay.
federal government. Well, they have a few funds. You know, they have a fund that goes with the S&P, and then they have the government fund, and then they got a couple international funds. And right now, since I'm retired from the government, I kind of play with it a little bit. Like right now, I put my funds back in G. So when S&P bottoms out, I'll put it back in the S fund so it'll go back up. But I play with it a little bit. But other than that, I'm just mutual funding right now.
Okay, that makes sense. If you're not a trader, if you don't want to do this,
Right.
To make a living, I want to do it to make a living. But
Right.
it's something that you said in terms of allocation. If I were to guess, your thrift savings plan is probably an index. I'm going to suggest maybe 60%, and then maybe some growth-oriented stocks, maybe tech for the most part, depending on what your risk level is. And then the last one you mentioned, international companies. I bet you guys understand now why the money managers have at least a portion of your portfolio invested in international companies. These are non-US companies. Who can tell me why?
Because you don't want to just be in one sector. You want to be have your money spread it out, so you stand a greater chance of making money versus losing.
Okay, yeah. Watch this. The US market is where most people, regardless of where they reside on this planet, want to put their money. It is an overvalued market. That means that people are willing to pay more money than what it is actually worth as a whole in terms of those future earnings and things of that nature. The reason it is important, and this didn't really make sense to me until this year happened. Guess what? The European markets, like the DAX, are outperforming the US market. So what are people doing? They are allocating, this is Americans now, they are allocating more of their capital to European stocks because they are outperforming the US markets. I didn't get that until this year because for the most part, bear markets are really rare. The markets generally trend upward. Over time, over the long haul, they always trend upward. Okay? And but we've had some bear markets. I think we probably only had 6 bear markets since the Depression, if I'm not mistaken. Okay? But now I understand why these smart money invest in international stocks so that when we're not doing well, there is a chance that they will do better than we are. And those European stocks are on fire. And the conversation now is U.S. exceptionalism. The period of U.S. exceptionalism, is it over? Okay, that is the scare. And you know why. You guys follow me on Facebook. You know who my arch enemy is.
Oh,
He is driving the rest of the world to disassociate itself from the US, even our best allies, Canada in particular and Mexico. Canada's our largest trading partner, and he has this zero-sum game where he wants us to win and everyone else to lose. And in a global economy, that's not going to work. I'm going to stop it right there. Any other questions? Andrew, you got anything for the cause?
In particular, I know when you talked about other ones that's been making gains is the Baba, JD, and Badu has been up and coming as well too. Baba was so beat down that it wasn't getting any action. Baba is kind of like Amazon. You know, they do a lot of trading with it's kind of like Amazon. That's the best way I can refer it to
Chinese
as.
company. Chinese company,
Mhm.
yeah.
And on the other side note too, MU got earnings coming up, so you know I'm gonna be watching that.
So you're invested in
That's all
Baba,
for me. No,
Alibaba.
I just I've been just trading options on it.
Oh, okay.
I have some stock in Bob back when it was like 60. So I just have some that I've been sitting on um because I just sit and wait and till the time to cash in. So that's what I'm doing. I'm just sitting
So what are you expecting it? Are you bullish or are you bearish on Baba?
bullish.
Okay. Okay.
Most definitely. I'm bullish on it because I've been following it for a while. Um And, I just know those in particular, they're moving because with all these tariffs and all that's going on, is a lot of uncertainty in the market. And that's another one I've been watching too is Berkshire Hathaway is BRK.B. I made out pretty good on that on Friday with
Okay.
options because I wait till it go down and then I ride it back up. So
Good
that's
deal.
where I'm at though.
Good
Well, other than
deal.
that, though, we'll talk offline though, because I know it's a lot going on. I don't want to take over the your class.
No, no, no. This is meant to be interactive. It is about 3:53 though. I don't want to keep you guys too long. I'm going to stop the recording as a matter of fact.
I'm probably gonna